Would you like to own a slice of one of the best businesses in the world? Want to benefit from a massive trend playing out in the United States right now? Like the idea of collecting a market-beating dividend that just got raised by 10%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. Also, make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is selling home improvement products and services to millions of consumers. A huge trend has been playing out for about a year now in the US. People have been moving out of smaller urban apartments in favor of larger suburban homes. And those houses? Yeah, they require all kinds of maintenance and repairs you never even dreamed of when you were renting an apartment. And maintenance and repairs require all kinds of products. The type of products this company is providing and profiting from. More houses, more customers, more product sales, more profits, more dividends. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Home Depot Inc., which appear to be trading at a significant discount today. Home Depot Inc., stock ticker HD, is the world's largest home improvement retailer. Founded in 1978, the company is now a $278 billion by market cap retailing juggernaut that employs 500,000 people. They operate nearly 2,300 stores across the United States, Canada, and Mexico. More than 90% of net sales occur in the US. The typical store averages 105,000 square feet and offers more than 35,000 products. Their e-commerce channel offers 1 million products. A huge trend has been playing out for about a year now in the US. People have been moving out of smaller urban apartments in favor of larger suburban homes. Undoubtedly, the pandemic and related lockdowns caused this trend to explode. Large cities like New York City effectively being abruptly and indefinitely shut down lit a fire under people and strongly motivated them to move on. But I'd argue there was already plenty of kindling there before the pandemic. Many people aging out of apartments had put off home buying for economic reasons. To that point, low interest rates only served to add more fuel to the fire. Cheap money has made the purchasing of a house more affordable and enticing. All of this plays right into the hands of Home Depot. As the world's largest home improvement retailer, they will directly benefit from more home ownership. After all those houses have to be maintained and repaired over time, and that's before getting into improvement projects. All of this will almost certainly translate into more sales, higher profits, and bigger dividends. As it sits, Home Depot has increased its dividend for 12 consecutive years. In fact, they just announced a 10% dividend increase near the end of February. While that's not nearly as high as their 10-year dividend growth rate of 20%, a lot of that prior growth was coming off of a near zero payout. But with a payout ratio of 55.3%, even after all of that massive dividend growth, the dividend remains highly secure. And you're getting this continued double-digit dividend growth on top of the stock's market-beating yield of 2.6%. This yield, by the way, is 40 basis points higher than the stock's own 5-year average yield. I consider the sweet spot for a dividend growth stock to be a yield of between 2.5% and 3.5%, paired with high single-digit or better dividend growth. This stock is right there. Looking at business growth, Home Depot increased its revenue from $70.395 billion in fiscal year 2011 to $132.110 billion in fiscal year 2020. That's a compound annual growth rate of 7.25%. I usually look for a mid-single digit top-line growth rate from a mature business like this, but Home Depot knocked it out of the park. This growth is especially impressive when you see that they started this prior decade from a rather large sales base. Meanwhile, earnings per share grew from $2.47 to $11.94 over this period, which is a compound annual growth rate of 19.13%. truly exceptional. A combination of margin expansion and buybacks greatly aided the bottom line growth rate. For perspective, the outstanding share count is down by about 30% over the last decade, which is a significant reduction. Looking forward, CFRA believes that Home Depot will compound its earnings per share at an annual rate of 7% over the next 3 years. In my opinion, CFRA is being reasonable here. Contrasting that 7% number with the 19% earnings per share growth rate that Home Depot has delivered over the last decade might look alarming at first glance. However, there's been a recent explosion in growth from the aforementioned pandemic-related trend that cannot persist forever. For instance, their mind-boggling 24.5% comp sales increase for the fourth quarter of 2020 is just not something investors should expect to continue. Put simply, the company's growth will start to normalize over the coming quarters. That said, I do think Home Depot is seeing long-term secular tailwinds take shape. Homes have been purchased, moves have been executed, and customers have been made. Even after the pandemic subsides, all of that can't suddenly be undone. Their market has expanded, and further government stimulus gives consumers, many of them new homeowners, more purchasing power. In addition, Home Depot strengthened its business model for the long haul by acquiring HD Supply Holdings Inc. for $8 billion in 2020, giving the company a strategic fit in the MRO marketplace and more exposure to the professional side of the business. With a moderate payout ratio and a high single-digit earnings per share growth rate, Home Depot should be able to easily hand out at least high single-digit dividend raises for years to come. Moving over to the balance sheet, the company has a rock-solid financial position. The long-term debt-to-equity ratio looks very high at 10.86, but that's only so high because of low common equity, which in and of itself is so low only because of a high amount of treasury stock, which is related to those big buybacks. On the other hand, the interest coverage ratio of over 13 indicates no issues whatsoever with leverage or its debt servicing. Profitability is extremely robust. Over the last 5 years, the firm has averaged annual net margin of 9.19%. Return on equity is not applicable because of frequent negative equity. Their net margin is extraordinary compared to the competition and retail in general. Retailers usually sport razor-thin margins. In my view, Home Depot is a wonderful business. Quality is very high across the board. And with huge scale, pricing power, brand strength, the specialization of their products, and a unique workforce that guides consumer purchases, there are durable competitive advantages in place. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. Retailing is one of the most competitive business models out there, limiting margins. Any major changes in the way consumers spend money can affect the business. Of particular near-term concern is the pent-up demand for services and the coming flow away from home improvement spending. Most of the company's stores are located in the United States. This greatly exposes them to only one market. A red-hot US real estate market could correct, which would likely negatively impact the demand for general spending on homes. I see these risks as minimal relative to the potential of the business over the long run. And that potential is exacerbated by the valuation. With the stock 12% off of its 52-week high in the best environment the business has ever seen, I think the stock is attractively valued. The stock's price-to-earnings ratio is 21.6. That's a reasonable number when you compare it to a much higher earnings multiple on the S&P 500. It's also off of the stock's own 5-year average price-to-earnings ratio of 22.9. There's also cash flow to look at. The price-to-cash flow ratio of 14.7 is quite a bit lower than its own 3-year average of 17.7. And the yield, as noted earlier, is notably higher than its own recent historical average. I value shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate is at the upper end of what I allow for in this kind of analysis, but Home Depot's fundamentals and quality warrant it, especially in their advantageous situation. This rate is lower than the company's demonstrated long-term earnings per share growth rate and long-term dividend growth rate. And I'll point out that the most recent dividend increase came in at 10%. With the moderate payout ratio and underlying business growth, I fully believe this company will meet or exceed my expectations. The dividend discount model analysis gives me a fair value of $356.40. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present present day to account for the time valued money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates HD as a 2-star stock with a fair value estimate of $216. CFRA rates HD as a 4-star buy with a 12-month target price of $300. I came out on the high end, but Morningstar's valuation looks quite low. Averaging the three numbers out gives us a final valuation of $290.80, which would indicate the stock is possibly 13% undervalued. Here's the bottom line, guys. Home Depot Inc. is a high-quality company across the board, and they're positioned to take advantage of the current U.S. housing trend with a market-beating yield, double-digit dividend growth, a moderate payout ratio, more than a decade of consistent dividend growth, and the potential that shares are 13% undervalued. This is a very compelling long-term idea for dividend growth investors. And now for a special news announcement. Johnson & Johnson's one-shot COVID-19 vaccine just received the FDA's emergency use authorization on February 27th. This is a big-time vaccine in terms of scale, cost, and distribution ease. It's a game changer that should get us back to normal quickly and also boost this company's reputation. Meanwhile, the stock doesn't look expensive. It remains one of my top 5 stocks for 2021. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.